Let's look at the US dollar against the Singapore dollar. First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So, we are at the 52-week lows and 9.42% away from the highs, which is, these are bigger. Well, vis-a-vis the pullback here, it's big in the Forex market. Here are the weekly data points, and we can go pretty far back. What is incredibly interesting is that this looks a lot like a very key horizontal support level. Key support back here and arguably a bit here as well. This is a level where we would expect the bulls to do something. The US dollar has definitively weakened against the Singapore dollar. Vis-a-vis time cycles, they have really differed in duration. But this pattern looks similar to this pattern, which looks similar to this pattern. And the previous times, it's been a very good time to turn bullish on the US dollar. Looking at the dailies, very low level at the lows from back here in March 2018. Let's look here at RSI. Extremely low level. We are at the low from back here in 22nd of January. This was a very good time to turn bullish on the US dollar in this pair. Also back here, also a good time to turn bullish. This is very, very low. On the dailies, very low here as well. This is definitively a rather interesting time to become a bit of a dollar bull. I write horizontal support and oversold, and I do give the bulls a whopping 7 here. I do think that this is a very interesting risk-reward opportunity. Next, we will look at the seasonality. To the left here, in green over the last 5 years, blue the last 7, red the last 10 years. Generally speaking, leading into late February, US dollar usually strengthens against the Singapore dollar. So far in January, we have lost 2% against the Singapore dollar. That is on the higher end of the spectrum. Generally speaking, looking at February, back in the day, it was very consistently a weak month for the dollar. But since 2018, we see that there's a bunch of green all of a sudden. So the long-term versus the more recent trend differs. Combining these data points, I will give the bulls, I think I will give the bulls here, I give them a 4. Overall, the seasonality is more bullish than bearish, but it's not super bullish. Based on other data I have access to, I will give the bulls here a 5 on the fundamentals. I can't share that data because of like license stuff. Let's look at relative performance against the S&P 500. We have minus 57% long-term, minus 73% with EWS, which is the Singapore stock market ETF. 15% positive with natural gas on the daily data points, minus 46% with S&P 500, minus 87% with EWS, and then 53% positive with natural gas. So looking short and long term, the strongest correlation we do get is with EWS, the Singapore stock market ETF. When we look here at this ETF, we see that it has had a very strong rally. We are approaching some overbought signals here on the weeklies, not yet, but approaching. On the dailies, we are overbought. This level on RSI is risky for bulls. When we look here at the seasonality, we have seen a bit of a flip. We usually see weakness into late January. We have seen strength, 8.42% so far for January, which is on the very high end of the spectrum. Recently, February has been a bit of a weak month, and especially when we have seen a very strong rally here already, then maybe expectations for the next month should be more modest. Given that there was a solid negative correlation here between the currency pair and this ETF, it means that if we expect weakness from the EWS, it would be bullish for the currency pair, which would mean bullish for the dollar. The dollar would then strengthen against the Singapore dollar. Here I am comparing the currency pair against the stock market ETF. In this case, especially when we look at RSI on the weeklies, we are approaching a level that has formed key lows in the past, where we have seen a tendency for being bullish on the dollar outperforms being in the stock market ETF. And when the currency outperforms stock market, that is quite significant, because usually the stock market will outperform sitting in cash. On the dailies, very oversold on RSI, a very abnormal level. Looking at the seasonality here to the left, we are seeing some expected weakness here in the seasonality. To the right, we do see in the table view minus 10% underperformance, which is very high. It is one of the highest underperformance readings we have. But if we look at some of the previous times where we have had substantial underperformance, February was actually a bit weaker in 2012. In 2017, you had continued weakness. So that is a potential risk. Overall, I do give the bulls a 5 here on relative performance. We do end up with a 5.3 here in favor of the bulls. We are at horizontal support. We are very much oversold. So overall, this is a very interesting time to turn a bit bullish here on the dollar. So we do have some time left. Let's have a bit of a look here at the US dollar index, the DX. We have seen weakness, but the last 2 weeks, the weakness has sort of, it hasn't stopped, but it's definitively reduced momentum. So the bears do not have the momentum they used to have. But the bulls are not really showing strength either, but here on the dailies, the bulls are fighting a bit here. The light red 10-day moving average is still a key resistance level here, so the bulls are being rather careful. The seasonality to the left is interesting, bullish. Minus 1.5 for January so far, which is bearish, but not like super bear. But looking at February, it usually is a pretty bullish month. So February for the DX is good, at least recently. And when you look here at the sum of the numbers, 9%, it's the second best month here actually for the dollar index, which is rather relevant, of course, for the USD and the currency pair. So yeah. Let's look at some alternatives. The GLD showing some strength here, but the rally is sort of fizzling out a bit. We have seen a very strong move, getting into a bit, of a dangerous territory here on weekly RSI and PPO. Not extreme danger, but risk. On the dailies, also pretty high. The seasonality here for gold actually is a bit bullish into mid-February. 5.6% so far for January, but it can actually go a bit higher if you look here at the history. But recently February has been a bit of a weaker month. Like purely tactically, it would make a lot of sense for the gold bulls to maybe relax a bit before they try to break out above the highs of 2022, or think about the highs of 2020. Because the key thing here is to have a long-term and sustainable breakout here for gold, instead of having a bit of a wily attempt when you already are at some elevated readings. Here is silver on the weeklies. Silver, it's pulling back a bit. So that is interesting to see that weakness here from silver. On the dailies, I mean, we don't have like astonishing weakness from silver, but definitively we have seen the bulls lose momentum. Very much also reflected here in the MACD. Accumulation distribution is actually very strong, so that's a bit of a bullish divergence. Looking at the weeklies, we're elevated. Let's look at the seasonality here. It usually actually is bullish into mid-February. Recently, though, going back here to 2013 even, February is like either bearish or very bullish. So that's it makes it less predictable. But March is definitively one of the weakest months here when you look at the sum here. But February is not really, I mean, it's a messy month. Okay, let's have a bit of a look at Bitcoin USD. No, yeah, okay, let's use that one. We are seeing strength. We are approaching the red 200-week moving average. A very important moving average because let's get my red color. You can see that it's where we fell from. It's also been where we have rallied and found support in the past. So it's definitively a very watched level. If we look here at RSI and PBOs, yeah, we are not in danger territory yet on the weeklies. On the dailies, oh, we are really though pushing it. So the bulls are showing strength, but I really do not like 83 RSI. That is very, very, very high. Let's look at the seasonality. The seasonality, it fits the trend. Usually the strength stops 11th-ish of February, and then we see weakness from Bitcoin. The current January with 36% gain is one of the best going back here. The only one better is 2013, but then February, March, April was very strong. So there could be more left here in this rally. But I'm not a huge fan of rallies when you are already overbought. It's just risky because you have situations where you have bears, of course, and you also have bulls that might offload positions, taking profits, because the bulls that got in at these low levels, they have 41% gain. And, there's a lot of things you can do with a 41% gain. That doesn't mean that the bulls will like exit all their positions, it's just that they will reduce. Something I like to do is that I split my overall position into like a long-term position, and then I have like shorter term positioning around it. So I could have a long-term like diamond hand position in Bitcoin. But when Bitcoin gets overbought, that is when I will sell, and then I will buy back on pullbacks. And when you do that sort of a bit systematically, buy low, sell high, then you can also enhance the gains. But yeah, Bitcoin is emerging from a low level. Let's look at Ethereum. Let's go to Coinbase. Ethereum is showing some pullback here actually. Looking at the dailies, so we got overbought, yeah, on Ethereum pulling back, but this is expected. 31% gain for January, but January, as you can see, it is pretty bullish, but for Ethereum. Looking at the seasonality forecaster here to the left, there could be more strength into 10th of February. So, looking at the US dollar, it's pulled back, but I think that there could be some bullish opportunities here. We looked at gold do a bit of a pullback. If we do get a regular pullback, that could be bullish for the dollar. Silver is showing some signs of weakness that could also benefit the dollar. Bitcoin and Ethereum. Bitcoin is still going pretty strong, but would be a good idea to have a little bit of a break, a bit of a breather before we take on that 200-week moving average in red. It's a very key level, and it's just more difficult to break through these kinds of super resistance levels when you are like super overbought on the dailies. It's just a bit too risky because you have both bulls and also bears, of course. That could add to selling pressure. You would have profit taking from the bulls, but a sell is a sell, you know. And if the majority of the trades that come in are sells, then it doesn't matter the intention, you know, of why people are clicking sell. It will then go down. So it's all about being a bit of a tactician.